The guest joined?
Just joining.
Okay.
Yes, sir.
Yes, sir. Yes, sir.
You're connected.
Yeah.
You have done.
Thank you.
Good evening, sir. Good evening, sir. You have to unmute yourself.
Yeah, good evening, Mr. Satish Ramanathan. Good evening. Can the host unmute?
Yes, I think yeah. Good evening, sir.
Good evening. So, thanks for giving us this opportunity. It's been a long time since we've interacted. And, thank you for sharing this platform.
Yeah. Yes.
If you have questions directly, we can do it that way. Or if you want to go through and then we...
Your volume is a bit low, sir. You have to be a little louder.
No, so couple of things. One is we have a presentation.
Yeah.
If you want, we can make this presentation.
No, we will share the screen to you, sir. You can do it, sir.
Okay, fine. I'll just share the presentation.
One second. Let me first do the formal welcome.
Right.
Good evening, everyone. On behalf of MSc FSL and also ISS, I have great pleasure in welcoming you all to this evening's webinar. We are very privileged to have with us Mr. Satish Ramanathan, Chief Investment Officer of JM Financial Asset Management Limited. MSc FSL has been conducting these webinars for quite some time now, and we have covered various topics. Many stalwarts from the market and industry have spoken on various topics. In that series, today we are privileged to have with us a veteran fund manager. May I request Mr. V. Nagappan, Director of Interconnected Enterprises Limited, to introduce the chief guest.
Thank you, Sundar, and good evening, friends. Today we are going to hear a market veteran, Satish Ramanathan, who is the Chief Investment Officer, Equity, in JM Financial Asset Management Limited. Many of us know him for the last almost 2 or 3 decades, and he brings with him rich and total work experience of 3 decades, and joins the AMC from Tarpa Capital, which was his entrepreneur endeavor. He started his career with Tata Economic Consultancy Services in the year 1992, and has subsequently worked with various organizations, including ICICI Securities, Franklin Templeton AMC, and Sundaram AMC. He is the primary fund manager for JM Large Cap Fund, JM Flexi Cap Fund, and JM Value Fund. And as he earlier said, I think he brings with him a rich experience, and at a scenario where the market has had a excellent run for the last 18 months or so. Almost, I think it's going to be 2 years if this March comes. In these 2 years, and now what should the investor do? Should we have to book profit or cut loss, or what is the strategy one should follow? What is how the economy is going to perform over next few months or few years, and where India is placed with Fed closing the liquidity tap, and the global inflation, particularly the US inflation at 40-year high at close to 7%, and UK inflation is also very high. I think many investors are confused with more opportunities like crypto and other things are also there. So how to navigate this? I think there is no other person better than Satish Ramanathan who can address this. And before I hand over the session to Satish Ramanathan, I would like to add to what Mr. Sundar said. If you want to track the various events conducted by us, in fact we have did events on sectoral events specializing in sugar sector, paper sector, and various other sectors. You want to know more about such events, you can track us in the Twitter or the Twitter handle, and also on the FB page. Regularly we keep doing these kind of events. And with that, over to you, Mr. Satish Ramanathan. Thank you.
Thank you, sir. Thank you for those very kind words. Am I audible now?
Yes, sir. Loud and clear.
Okay, fair enough. And I just wanted to, give you this, take this opportunity to thank you all, one. And second is that also to highlight, this period of good period in the markets and how things will stabilize over some time. And we also need to kind of be a little careful with allocation. And from there, take it forward because, this volatility is not going to be easy because there are so many unknowns in that sense. So having said that, I don't want to sound extremely pessimistic, but at the same time, we have had a good run last year with the market at 24% return in the large caps. Mid caps are given close to 36 and even small caps 54%. On a 2-year basis, we have seen the returns being quite dramatic at almost 100% in the small cap fund. And all this has happened with a reason. One of the key things that we want to highlight is corporate balance sheet improvement has been consistent. We have seen corporate India reducing debt continuously quarter after quarter, year after year. For instance, SAIL had something close to 60,000 crores of debt, and that has come down to almost 17 to 18,000 crores debt, and they plan to reduce it and become debt free in a couple of years. So these kind of things have happened. And we are seeing that corporate India is doing very well in terms of cash flows. And whether it be IT company, whether it be a commodity company, whether it be banks, the entire health of the Indian companies, corporate India has improved. So that is a positive that we need to keep in mind when we make a forecast of the future. The second thing that we want to highlight is that, there is a small recovery in CapEx because companies are becoming a little more confident about the demand outlook. And most of these people are actually trying to buy companies rather than setting up greenfield plants. So there is a little bit of brownfield CapEx. There is a little bit of acquisition, M&A taking place. We have seen many M&As taking place in the steel sector, and that has helped in consolidating the industry. So what is happening is, for instance, in the steel sector, almost 60 to 70% is now controlled by 3 to 4 big houses. They are Tata Steel, Jindals, Mittals, and SAIL, and to some extent you have Nippon group of the Mittal of Nippon Dendro Ispat. So all of these kind of things have taken place, and we need to bear in mind that this consolidation, like steel, cement, and all of that, has helped the commodity pack tremendously. And it has been the commodities that really helped in pushing up earnings in 2020, CY 2021, and may continue to do so in CY 2022. And PSU banks, which have come out of a long period of restructuring bad loans and writing off bad loans, for them, the profitability has suddenly improved because their provisioning cost has come down dramatically. So that is another thing that we need to bear in mind. And the growth is also normalizing in some areas. For instance, we saw pent-up demand in consumer durables, in some cases auto. All of these cases, there is some normalization of growth. And therefore, what we are seeing is that the returns and the earnings growth has been muted to some extent. And finally, there's central banks as to how they want to tackle inflation versus growth. Now, I will spend 5-10 minutes on this aspect because this is the most important aspect for us from forecasting what will happen in the markets, etc. Central banks are reluctant to raise rates primarily because of two things. One is they don't want to kill the growth, and the second thing is in many ways post next September, October, or by June, July of this year itself, we will see inflation normalizing and the base effect setting up. So that is what most central bankers think, and they do not want to kind of upset the growth momentum that has been built up so with great difficulty. So therefore they are reluctant. But having said that, the US is at a negative real interest rate of 7%, whereas India is only at 2%. And US has to do something from zero to push it up to something meaningful, and also help in balancing its economy. What does it mean for markets? In terms of equity markets, we will expect to see some volatility. If one is if China normalizes post-COVID, people start importing goods and goods are available, freely available, the inflationary pressure will cool off on one side. The second side, we will see the US Fed take some action over the next 3 to 6 months. And when they take action, that itself will also cool off sentiment, consumer sentiment to some extent. And these two will balance and probably reduce the overheating. And if in the meantime we have Ukraine and all these issues being resolved, to some extent we will see normalcy returning, and we could see inflation cooling off for a longer period of time than we expect. And when that happens, markets should stabilize. But structurally, there are 2-3 drivers which are for inflation, and I want to highlight these as well. There has been a significant underinvestment in a lot of commodities like coal, iron ore, crude oil, etc. And while on one side we will want to use alternate sources of energy, India and some of the Western countries cannot move fully to solar or wind because the energy is very volatile. you need gas or coal to stabilize the energy grids. And that is exactly what has happened because they have not invested in exploration and drilling. And there could be a structural shortage for the next 3 to 5 years, which pushes up these prices to a level which is something which we have not experienced in recent times. For instance, many houses like JP Morgan and even Morgan Stanley, etc., they are now forecasting oil at $125 per barrel. And whether it reaches there $110, we can never say. It can even drop to $70. But but the basic thing is there a shortage of production relative to the current demand scenario, and that makes inflation a little more sticky than what we have seen in the past. And we should anticipate a higher degree of inflation coming through for the next 3 to 5 years, not something which we have experienced in recent times, because we have seen very benign inflation in recent times. That will set up about a chain reaction. Wages will have to go up, labor will have to go up, and then commodity prices go up, and then all of these things is in a way going to happen. The benefit of this is that people will start investing in real assets, because till now most people have been putting off investing in real assets because capacity utilization was low, consumption was low, imports from China was high. All of this will kind of cool off, and therefore from an Indian economy point of view, I think a lot of drivers are turning positive for the next 3 to 5 years. Now you may ask, what is in it for the market for the next 3 to 5 years? We need to be patient for the next 12 months, and kind of because there will be a lot of this volatility that takes place, and we will have to have some kind of shock absorbers, whether it cash or investing in some liquid funds or whatever it is, to help ensure that the portfolio volatility is reduced, and also to then take forward the investment theme. The second theme that we expect to take place from the country point of view is big getting bigger. Because if you look at groups like Tata Steel, Reliance, Vedanta, Adani, and to some extent even the Birla Group, they have consolidated manufacturing sectors, all these sectors, and their cash flows are very strong. They have pricing power, and they have almost, for instance, Reliance is generating 1 lakh crores per year in terms of cash flow, and he needs to invest that much for him to grow to the next level. So, I mean, you look at it, the union budget, we all got excited that they were giving 1 lakh crore to the states. And we said that that is going to add to the capex. But private India's capex will be equal to, if not greater than, government capex if they start investing. And therefore, we need to create that environment for government to start investing. So that is the second point which makes me positive. The third point that makes me positive is that China, because of its aging population and its currency hardening vis-a-vis the INR, if you look at it from 2013 to 2022, in a matter of 10 years, Indian currency has halved in value relative to the yuan. So the yuan is now 11.86 rupees, whereas it was just about 6 about a decade ago, which means Indian cost of manufacturing has become very, very competitive. So we are seeing some kind of traction in textiles, light engineering, etc. So exports will be doing reasonably well at about 33% export growth that we have seen in 1 or 2 months. Is not a flash in the pan, and we need to kind of identify sectors, themes that will go with that. So it could be engineering, it could be software, it could be textiles, it could be shrimp, farming, agriculture. All of these sectors are expected to do reasonably well. And that is what we are trying to bring into our portfolio also. One, to have global leaders, champions in the portfolio. And the second is to look at emerging trends and new stock themes and ideas in our portfolio. So this is the outlook on the market. I will just take you through. So I have covered broadly everything, so I don't want to kind of discuss too many things. Let me just look at this table. If you look at the price earnings chart, the price earnings, we have been ahead of the average, long-term average. And I think that by the end of this year, by June, July of this year, we would have cooled off by 5 to 10%, and earnings would have also expanded by 5 to 10%. And we would be about 20% cheaper, which would be bringing us closer to median valuations, which would be the time to start picking up and adding to our equity holdings. And again, between large cap and mid cap allocation, I think given what I have stated in terms of the scenario where large banks, large companies, large PSUs have tremendous cash flow and power to invest, I would think that we should continue to have a higher allocation to large cap, and which will kind of buffer the portfolio and use mid caps and small caps to capture the growth and the entrepreneurship that we have seen in India in the past as well. So that would be the broad mix and strategy that I could adopt. And if you look at what has happened in the market in terms of the key stocks that have done reasonably well, if you look at it on a 6-month basis, it has been ONGC, Tata Motors, Titan, Power Grid. So a mix of value and a mix of growth. Indian Oil, Bharti Airtel, State Bank of India, Maruti Suzuki, NTPC, Tech Mahindra. If you look at the 1-year basis, on a 1-year basis, it has been Hindalco, it has been ONGC, Tata Motors, SBI. So you see on a 1-year basis, value has clearly performed vis-a-vis growth, and all the PSU stocks have actually been among the better performers. And we have seen some derating of pharma stocks, primarily because of US price control and price reduction, which has impacted margins and growth. And the auto sector. Just to highlight on the auto sector, while there is a pent-up demand for cars and UVs on one side, there is also people are kind of confused on the transition to EVs for two-wheelers. And our two-wheeler demand, as it stands today, is something close to the levels that we have seen a decade ago at 2012, 2013. And we expect that probably with the advent of EVs and also some kind of recovery in consumption and consumer demand, we should see some kind of a growth re-emerging in the two-wheeler market. And so that's what we wanted to highlight. And in the next slide is a scheme summary of our schemes. Just to highlight, I need to highlight that we are a small fund house. Our active equity portfolio is about 575 crores. And consequently, we run a fairly concentrated portfolio of about 30 to 33 stocks. We do not have about 60, 70 stocks in the portfolio because our size gives us the luxury. And we drive high conviction ideas. We do not try to just over diversify. And we are willing to cut existing names and move it to higher returning assets, yielding assets. And we control the risk profile also reasonably well. So if you see, the quartile ranking on a 6-month basis, value just slipped a little bit to about third quartile, but is back to the second quartile now. Flexi cap is our first quartile, core is first quartile, tax and large cap are second quartile funds. So just to highlight that we are a small fund house, we agree, in that sense, we may not be in the best position to over diversify, but we have managed risk and delivered returns for the investors reasonably well. And we have a fairly rigorous process in place to monitor risk, and the quality of names are all blue chip names, which we do not want, to dilute the investors by trying to play too much in the mid cap and small cap space. So with this, I can open the floor to questions. If you need anything else, I mean, we have team return these kind of data points for you, and you can take it from there.
Thank you, sir. Thank you for the nice presentation. Now the floor is open for questions. Anyone who wants to ask question, either you can ask directly, you can raise a hand, or you can use the chat box for putting your questions across. So the floor is open. Probably let me start with the first question. Sir, you are telling about the views on PSU banks as a class. What do you feel is a way forward for PSU banks as a lot? Do you think they can be expected to be outperformers, or say regaining their old glory?
So PSU banks have very good franchises in terms of their savings bank account, etc. And people feel comfortable banking in PSU banks relative to some of the large private sector banks. I mean, because in Mofussil and rural India, people feel very comfortable with PSU banks. Now, within PSU banks, there are the tier 1 banks, which are, SBI, PNB, BOB, and Bank of India, etc., who have automated and are in a position to kind of outperform. And within the second tier banks will have to find a future direction in terms of growth and in terms of how to kind of reduce cost and move forward. PSU banks unfortunately do not have the ability to lend because they have been constrained and people are scared within the banking system to lend. And consequently, if growth comes back, we are of the view that private sector will still outperform relative to PSU banks. And this is a valuation trade where you buy a bank at half times price to book value and sell it at 0.75 or 0.8. If the government is serious about the way forward for PSU banks, they will actually have to start selling a couple of banks to private sector to turn it around. And that would lead to an immediate and a quick re-rating of these banks.
Yeah, thank you, sir. Thank you, sir. A question from Mr. Nagapan. What are the 2 or 3 favorite sectors which investors should look out for going forward, and which are the ones to avoid in the near future?
So, as I alluded to in my presentation, we should be looking at export-oriented sectors. And in that, IT still is one of the good sectors because they do not require too much capital. They generate a lot of cash flow. And we need to buy it at the right valuation. Many of these stocks have corrected by 15%. I would still say that at about a 10% correction, these stocks make a lot of sense from the portfolio point of view. That's just one. Second sector that we also like is the textiles and chemical sector. Textiles has run up a little bit, and there are some shortages in cotton, etc., etc., and they are not able to fully, kind of put money and deploy capacity. But textiles would be one of the sectors that would do reasonably well for a medium-term perspective. The third sector we still would also back is the manufacturing sector and the industrial sector, because we think India will continue to do reasonably well. If you look at our portfolio, we have some of the best companies like SKF and Cummins and even Bosch. And we believe that all of these three companies would benefit from exports, would also benefit from a domestic recovery.
Thank you, sir. The next question is it now is the right time, or you have to wait till end of the year to invest?
No,
So Ranga from Coimbatore has asked the question.
Thank you, Mr. Ranga. But we should use every fall of 3 to 5% to put some money, because we cannot say what is the top or what is the bottom. So, but wait, whatever we have seen markets already correct by 10%. So on a weekday, when you see markets fall by 1.5%, that would be the time to put some money to work, and wait for 5% correction points to start investing. Because this, as I said, we do not anticipate a rapid fall because of the domestic money supply and domestic investors and the younger people to come in. Also, don't forget that if IT sector revives and they create 20% more jobs, many of these people will use mutual funds or equities to save. And today it is no longer a foreign portfolio who decides what the share price of our companies would be. It is domestic investors who are setting the price. I hope that answers your question.
Okay, sir. Before the next question comes in, probably one point which we cannot miss at this time, your views about LIC IPO and the impact of that on the market.
I think the impact on the market is broadly over, because a lot of people have been living with the fear of LIC IPO, etc. Prima facie, it may be a case where it could be a little overvalued, even though it has a monopoly situation. What we have been seeing in the insurance sector is that life insurance sector is that people are moving towards term cover, and on one side, and the other side they are kind of using mutual funds to do the savings. The combined product, ULIPs and annuity products, are no longer in vogue, and consequently the profitability of the industry is a little bit under pressure. So we have to bear that in mind, that LIC will also be kind of benefit impacted by this, and many of their existing portfolio has done very well because they've had the advantage of legacy for the past 20 years, 30 years. People are contributing, and that is extremely profitable. But new business is not as profitable as old business, and we have seen that typically PSU investors are not very kind towards PSUs.
Thank you, sir. Thank you, sir. Next question from Mr. Easy Ram. FIIs have been continuously selling and domestic investors have been continuously buying. Do you think Indian stock markets can hold on for long in this kind of a format?
So that is what I was saying. The structure of the Indian market has changed, and it is for the better. The FPI and investors are only contributing about 20 to 25% of the volume. 25% of the volume is now coming from institutional investors, and 40 to 50% of the volume is coming from retail investors. So in that sense, despite them selling almost $11 billion from October, the market has absorbed all of this. I don't see too much of an impact going forward from these sectors, and they have over-owned the financial services sector, which is why we have seen some of the financial services companies getting impacted, such as the HDFC, Axis, and all of these, where the FII holding was very high. Those stocks have not performed as ICICI Bank, where their ownership was not as high, or for that matter, even SBI. So that is the reason why we need to kind of bear it in mind and kind of take it from there.
Sure.
So I think there was some question.
1 second, sir. I'll just read out the next question. Mr. Shiva, how about long-term approach for these sectors, IT sector? There are more automation that is going on, and most of the customers are moving their workloads into cloud. So under these circumstances, what sort of impact you are expecting to the Indian IT stocks?
Good question. Thanks for the question. In terms of IT sector, yes, there has been continuous, automation as they move to the cloud. But also what happens is, once you move to the cloud, to use the power of the cloud, you need to continuously invest in programming and invest in new products, and then get the customer. And the fintech sector, we have been talking to a couple of people. We spoke to yesterday we had Mr. Uday Kotak in one of the conferences. And what he was saying is that the fintech is way behind in terms of IT and IT sector touch and feel. And we allowed people like Zerodha and all of these people to get ahead of us. We have to invest a lot to get back into the game. So there will be investments. And if you look at the project sizes of Indian IT spend, Indian government, even the visa passport, offer project, or the Aadhaar project, ration card, all of these kind of IT spends in the domestic market will also become big and start growing. So we probably the next 2 years we will see a lot of growth, and then it may taper off. But in terms of our cost of labor, in terms of our technology capability, I think Indian IT has come of age and will stand its ground, especially the larger companies that we are discussing and investing in.
Thank you, sir. Next question from Mr. Suresh Iyer. Sir, how about automobile sector, since electric vehicles is being encouraged? What sort of impact will it have on the automobile sector?
So to some extent, we are seeing a beginning of that taking place in the three-wheeler market. We have a few companies actively exploring, such as CG Power and Greaves Cotton, and all of these companies are exploring three-wheeler battery swappable technology. I think the first to move towards EVs will be the two-wheeler and three-wheeler industry, because it makes a lot of sense and it is practical also. But this can come only if the industry sits together and sets a template and a common module for batteries, common module for charging, and then charging stations come up. And we need to also have a pragmatic government to allow this, because ultimately the government will lose tremendous amount of revenue if we go into EV. So just assume that they make 50 rupees per liter of petrol, the government, both state and center put together. And if 70% of the petrol consumption is from two-wheelers, and two-wheelers start adopting into EV in a big way, we could see a fair bit of contraction in revenues for the government. So government on one side wants to say we promote EVs. On the other side, it is actually quite scared that EVs will take over. It is like cigarettes, right? If they wanted, if cigarettes were bad for health and they wanted to make people healthy, they could have abolished cigarette manufacturing in the country itself.
Correct. Thank you, sir. Next question from Mr. Kalanidhi. If you already invest in long term, say more than 2 years, should we be averaging now or just wait?
I think if you are in a large cap fund, I think you can just keep waiting and probably wait for corrections and average. If it is a mid cap fund, we need to look at what the risk profile of mid cap fund is, because some people, the skewness of the mid cap fund, etc., can vary across mid cap fund houses. Therefore, I can't comment on mid cap funds, but on large cap, in general, I think will be less volatile than what the rest of the other portfolios, and one should hold on and keep averaging as it comes down.
Thank you, sir. Gautam from Coimbatore. Why interest rates are important to the currencies?
So the basic thing is that interest rates keep the currency attractive. So if I keep very low interest rates, people will go to another country which has a higher interest rate or lower inflation. So in India, given that we have a higher inflation, we need to match the interest rate with that inflation. So that is why people
Like there is a problem in the network.
Hello? Hello?
Yes, sir. Yeah. Go ahead,
Yeah.
sir.
Sorry, there was a bit of a power cut in my place. So
Okay.
I had to
No
get back.
problem.
Sorry. Yeah.
No problem.
I don't know what was the last question and whether I missed something, but please go ahead and ask me.
One second. One second. Yeah, it was about interest rate and currencies.
Right. So, in terms of the interest rate, as if the US raises interest rates, what happens is that money will leave other countries and go to the US because it's a more stable currency. So they can probably raise rates by 1% or 2% and nothing may happen. But beyond that, what will happen is that India will also have to raise rates to ensure that money, especially currency INR, if it gets converted to dollars and moves to the US, then our forex reserves may come down.
Okay.
That and Indian currency also. I hope.
Yeah, some disturbance in the audio from your side.
Okay, I'm sorry.
Hope you are able to hear us properly now.
Yeah, we can hear you. I can hear you.
Right, sir. So next question from Mr. Shiva. Increasing demand of power requirements in every house and EV vehicle promotion from the government agencies, will it give an opportunity to grow the energy sector? If so, is it the right time to buy Indian power stocks?
No, so 3 things are happening on the power side. One is over the last 3 to 5 years, as you are aware, industrial demand was weak and only household demand was strong, and therefore power demand growth was muted. One. Second is that we added a lot of solar, which kind of contributed to the reduction in power offtake from thermal power plants. The thermal power plant current capacity is only about 50 to 60%. And what has happened in recent times, and I don't know whether it will sustain, is that if tomorrow we see a situation where domestic coal is significantly cheaper than imported coal, a lot of captive power plants will switch to the grid, and the grid will have to buy power from the large power producers such as NTPC, JSW, etc. And they will consequently make a little bit more money. Having said that, if you look at JSW Steel, it has moved up from 75 to 375. And Torrent Power has also given very good returns, as also Tata Power. So there are one or two stocks which may do reasonably well, but beyond that, I think the power sector rally is broadly over in terms of the stocks that have run up. So yes, they offer good value, but we also have to understand that they have run up quite a bit in recent times.
Okay, sir. Thank you, sir.
Thank you.
Mr. Mohan, what will happen to our market if US interest rate is hiked? Which will be the sectors which will be badly affected due to this?
So in lot of debt. In today's context, I think corporate India's balance sheet debt levels have come down. If US interest rates start going up, it may impact commodity sector because commodities, two, three things. One is the money flow into commodities will come down, speculative interest that is. And second is that you will also see to some extent high PE stocks that were supporting valuations of 40, 50 PE. They will also become vulnerable. So, in short, if US interest rates go up, we have to be prepared for a market fall, and we cannot try to say that only this sector will go up or sector will come down. The sectors that will experience the least fall will be the sectors that are reasonably valued with low debt and benefit from currency depreciation, such as export-oriented companies.
Okay, sir. Thank you, sir. Next, from Mr. Srini, your view on Russia-Ukraine tension.
So, hello?
Yes, sir. Your view on Russia-Ukraine tension.
Yeah, so in this Russia-Ukraine tension, two, three things we need to bear in mind. One is that the reason why this is happening is some geopolitical thing. We cannot kind of take a call on what will happen, and all of them are very strong people. You have Putin on one side, you have Germany on the other side, you have Ukraine on the third side, and then you have Biden on the fourth side. We really sitting in India can't say anything, but our guess is that if the snow thaws, the many of the tanks cannot run inside Ukraine. So if there is an attack, it has to happen in the next 15-20 days. If not, nothing will happen. One. Second is that Russia has already played its cards as regards crude, as regards gas, and Europe has been exposed by its vulnerability. I'm sure next 5 to 10 years they will, get alternate sources of gas and energy to kind of insulate themselves or de-risk themselves. 2. 3 is that if they were to kind of play this game, it will be a ultimate one-time game that they can play, and Russia will struggle after that. So it's a game of brinkmanship, but it may not lead to anything, is my considered view, but we don't know. With very strong people, strong egos, anything can happen.
Thank you, sir. Next question from Mr. Easy Ram. How exactly does Fed remove excess liquidity?
No, so excess liquidity is removed by 2-3 things. One is to not to infuse extra liquidity and to start, to start capturing the extra liquidity by not rediscounting the bills. And there are several ways where liquidity can be reduced by increasing the cash reserve ratio or whatever it is. So there are a lot of instruments in the banking system to reduce excess liquidity or reduce exposure to a particular sector by increasing the risk limits and etc. These are, it's a very intricate science. It cannot be just kind of, it's not like a, something saying that I will use one instrument to reduce liquidity. There is a mix and match of several instruments that the Fed Reserve or any central bank has to reduce the liquidity.
Okay. Thank you, sir. Next question from Mr. Suresh Iyer. Sir, it's always been advised that one should not invest in penny stocks, but some of the stocks grow well, so that so what is your advice that how do we identify and invest if needed?
So there are lot of people have many, to be an abnormal.
Your audio is breaking, sir.
Hello, can you hear me now?
Yeah. Yes, sir.
So, I mean, the basic thing is penny stocks. I mean, there are some stocks that do reasonably well and ensure that, these penny stocks have delivered good returns. Some other stocks have taken away money and people have lost. My only request is when you look at a penny stock or a low PE stock, please do your own work. Convince yourself whether the promoter is good, the business is good. Please don't invest because someone else has told you. So if you read the annual report, you are able to see whether the man pays dividend or not, what is the reason, etc., etc. Kindly do that kind of diligence work, etc., before you invest in any small cap stock or small PE stock or penny stock or whatever it is. If you do not see a dividend in the stock, then you have to be wary and suspect. This is my sincere advice, because extreme greed comes at extreme peak of the market, leading to extreme losses. So when we are clear about that, I think we have all lived through 3-4 financial cycles. So therefore, I can only advise that please be careful.
Thank you, sir. Next question from Mohan. It's about long-term capital gains, the period being increased from 1 year to 2 years. If that happens, could this be a trigger to the markets?
No, I think the basic thing is that this trigger to the markets is something going to be, which will take place. I mean, if they make it 1 to 2 years, it's actually slightly negative, because people will not have that patience to hold on for 2 years. There is some talk of rationalizing the entire long-term capital gains, because different asset classes have different rates and different time periods. Whether if they make it 3 years for equity, I think it will convert equity and debt into a similar asset class. Otherwise, they have to make debt, real estate, and equity 1 year or 3 years. This is the basic thing that they will do. And we have to if they make it 3 years, you really have to do good work in terms of selecting your companies and keeping it. And it makes mutual funds that much more attractive as compared to investing on your own.
Thank you, sir. Next question from Mr. Prakash. MRF quoting at 65,000 and Tata Motors only 490. Tata Motors is a good company, good capital, good revenue. Why it is not moving like MRF?
No, I think, see, please don't look at the share price, look at the market cap of the company. The market cap of MRF is, one second, let me just, share price is a function of the number of shares. MRF has not diluted or given a bonus. Market cap of MRF is 27,000 crores. And it supports a last 12-month profit of 836 crores. Whereas Tata Motors, even though it makes a lot more capital, the net market cap is 1,75,000 crores. So MRF may be 65,000 rupees, but the market cap is what we look at, which is 27,000 crores. And Tata Motors is 1,75,000 crores. And the trailing 12-month profit for Tata Motors on a consolidated basis is still negative. So that is the reason.
And your view about the recent high-profile listing and many of them, being in the red in the recent times. Your general view about that?
No, so I think in many aspects it was a wake-up call for the retail investor and the institutional investor. That just because the stock market is frothy, if we go and invest and we kind of this thing, 2-3 things. One is in an IPO in general, the results are exaggerated because the company tends to IPO the company itself only when everything looks very rosy. So after the IPO is over, within 6 months, you see profitability coming down, profits coming down, and then they say that something has changed, inflation, blah 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 blah. So that is one part of it. The second part of it is that when you buy a loss-making company, it is equivalent to the previous question. At what price will you buy these kind of companies? And you have to see whether you will make
We seem to have lost you, sir.
No, I've come back. Sorry.
Yeah.
Can you hear me? Yeah. So
Yeah.
you have to see if profits are coming after 5 years, 10 years, and what is the cash generation of these companies, because that is the most important thing that we need to bear in mind. And most investors kind of get carried away, and that kind of hurts when it falls. So that's about it. I mean, you get what you pay for, and if you do not exercise your due diligence, you cannot blame the stock or the company or this thing. You have to blame yourself.
Very sane advice. Yeah, thank you. Next question is from Mr. Srini. Can we expect a 30% fall from Nifty if from the top of say 18,604?
See, I cannot rule out any possibility, but our base case assumption is a 5 to 10% fall. Let us, we are making projections, assumptions based on that. A 30% fall can happen if tomorrow Putin attacks not only Ukraine but Germany also. Anything can happen. So, I mean, I'm not ruling that out, but on normal basis, we think that hello?
Yes, sir. Go ahead, sir.
Yeah. So that would be our base assumption.
Next is we have seen some bit of correction in quality stocks, but still valuation appears to be high. Should we be adding these things to our portfolio with value investing perspective?
So I think in terms of quality stocks, valuations are reasonably high, and that is why we said that we have time for the next 3 to 6 months when the market can correct a little bit and earnings also stabilize and start growing. And at that time, effective PE of the company will be about 15 to 20% lower, and that would be the time to start investing.
Next question from Mr. Mohan. How does SEBI do the valuations for new age companies like Zomato, Paytm, etc. before giving the approval for IPO? Do they have a mechanism or go by the merchant bankers valuations?
I think SEBI is no longer setting a price; those days have gone, and therefore it is the merchant banker which sets the price. And what we have seen in the recent times is that SEBI has no control over that. Those days have gone, and SEBI is only an kind of an administrator stroke sets the rules, but SEBI does not play all this on setting the price.
As they say, they only vet the document. They don't approve or disapprove the document. So, which means it is for the buyer beware only. It is for the
Buyer beware, caveat emptor.
Yes. Any more questions? I think that seems to be it. So, thank you, sir. Thank you very much for your patience, for answering. So, one more question just cropping up. Why dollar index is different from other currencies? Why dollar dominates the globe? Because of
dollar is the most dominant currency, and that goes without saying because of a lot of geopolitical maneuvering and all of this that has taken place. So we cannot question certain truths that have emerged over the past 50 to 70 years. Pre-World War II, it was the pound, British pound, but now it is the dollar. And therefore, that is the way it is. We cannot challenge that.
Probably rupee from another 30, 40 years down the line.
Whether it is yuan or rupee or whatever it is, Bitcoin or gold, who knows? But
next question.
I think there is a
yeah. Go ahead, please.
there's one question about cryptos, but we do not comment on cryptos because we haven't studied it adequately. I'm not on top of that, so I don't know, and I do not want to give any comment which is misleading on that.
Do you, because of current correction, do you think retail participation will go down?
It is a possibility. There are 2-3 reasons why retail participation can go down. One is if offices start and people start going to work, that itself will make people trade less. There won't be time to trade. Today, everybody has got a trading platform in their house. They are working half time and trading the other half of the time. If people have to go to office with their compliance and all of that, I think that itself will reduce trading. That's one. And second, if they make a little bit of loss, I think trading volumes will go down.
Should SEBI get involved in pricing? Valuation?
No, I think, there is always this debate about free markets and ability to price, etc., etc. So SEBI getting involved into pricing will, restrict one more level of economic freedom. I don't know whether it is advisable or not, but if people come up with outrageous valuations, then we can expect SEBI to get in and do something. And it will be short-term positive and long-term detrimental to the entire issue.
Any thoughts about governance and exchanges relating to recent NSE issue?
See, I don't know whether that is something which we need to focus on. Having said that, as a buyer, are we getting a fair price with very good transaction quality, efficiency? India is amongst the better stock exchanges in the world. You are able to see the price, you are able to execute the transaction, you get an automated contract note. Without a problem, the money leaves your bank account and goes into the demat account. In terms of stock, without any problem, you can sell a stock in 2 days, 3 days time. So exchange, yes, there have been issues, and it has been far beyond what we understand or know. Whether the managing director of the exchange actually looked at a yogi, Baba, or what, it really doesn't matter to me, because ultimately I, as an investor, have been able to invest with very low friction cost, very low transaction cost, and high speed. And whether she looked at the sun and got her ideas, or she looked at a yogi and got her ideas, how do I care?
And just as a continuation of that, how do you compare Indian stock exchanges to the global peers regarding efficiency, the speed, and everything?
I think we are amongst the best.
That's wonderful to hear, sir. From a person who has exposure to the global markets, when he says that Indian markets are among the best in the world, we have to be very proud of. We have to be very proud of being
Yes.
part of the global leaders. I think we have already run it more than 1 hour, 1 hour, 15 minutes. Thank you very much, everyone, for your questions. And thank you very much, sir, for patiently answering all the questions. It has been very interactive. It would have been very useful for many. Many of their doubts would have been clarified. This video will be available in YouTube for people who missed out or subsequently could not, take down some other points. It's available on YouTube. You'll be able to go through that and get clarity on some other points if you had missed. So thank you very much, sir, once again for a wonderful presentation and accepting our invitation and coming to the webinar on behalf of MSc FSL and also Interconnected ISS. Thank you so much, sir.
Thank you. Bye and have a nice